Hello and welcome to Currency Point, presented by me, Evan Lucas, for FP Markets. As always, please have a very good read through of the disclaimer on screen. Everything in this video is general in nature, none of it should be relied upon as any form of personal advice. FP Markets does not know your personal scenario nor your personal financial goals, and therefore none of it should be relied upon as any form of advice at all. It is just general in nature only. I was a bit late, but it's finally come about, and that was what we talked about pretty much at the end of March, was what we expected to see with going on in Q2, was whether or not data would finally start to overwhelm the Fed's talk. And last week, it probably came to fruition that they have. And I need to really highlight how strong a break we now are likely to see, with that FOMC clearly suggesting that they're going to have to start moving. I know not everybody will agree with this, and that's fine. But if you have a look, let's start with this chart. This is Aussie US, and the breakdown there is absolutely stark. I've been waiting for this to happen. The Australian data on the Aussie side has been really strong. And then you look last week at May's numbers for employment, where there was 115,000 jobs added, unemployment at 5.1%, yet it did nothing. It did not only nothing, in fact, it accelerated what we're currently seeing with regards to the strength in the USD. And that's what I want to talk about, is that you can talk about this now, that the US dollar weakness that has been going on since March looks to have finally broken. Dixie is pretty strong on that. The only one that sort of slightly missed out in terms of catching the wave per se is probably dollar yen. That's not surprising. Dollar yen's actually been really strong. It's gone through 110. Yes, it's eased off slightly, but it's still incredibly strong. And looking at where it was, about 3.5 months ago at 104, having 6 yen movement is pretty strong in terms of what you see. I then need to highlight why. Look at the upgrades that have gone on, particularly in things like unemployment in the US. Have a look at also their expectation around GDP, 7%. That would be the highest GDP growth in the US since the Second World War. That's how strong they are moving in terms of that space. And then it's the PCE and CPI that cannot be underestimated what it means. Having to upgrade PCE from 2.2% to 3.4% is an absolute contrasting discussion about what they've been saying in the public and what they now believe will happen by 2021. Yes, they're still using the word transitory, and yes, that's fair to call. There will be parts of this whole discussion that will see it ease up, but there's also clearly parts that are structural, and I think that is sometimes what's lost in this discussion. There are definite parts of the infrastructure movement, definite parts of retail, definite parts of employment. They are not transitory in inflation numbers. They are actually structural, and the Fed is now aware of that. The dot plots, in terms of what it now shows you, is that yes, 2 rate rises in 2023, but more importantly, there's now 7 members that believe they could possibly see 1 rate movement in 2022, which therefore brings me to taper. Although he used this very strange term of talking about taper in his press conference, Jay Powell is very clear that if they're going to start using the taper talk, they're going to have to massage the communication well. But it also sounds like they know it's going to have to start soon. And by soon, I'm talking Christmas. It's not going to happen in 2021 because I think that would look like a bad scenario considering how strong they've been this year. But it's going to start next year. I think that's now a fairly reasonable possibility. And that gets back to the trading. The FX is telling you that. The US dollar now has probably shown you that it's about to be released and that there is going to be some strength. And that looking here at euro dollar, it's gone from 121 to 119 to 118, lowest read in 6 weeks, and the momentum is to the downside. Not surprising. Have a look also at cable. Cable's had a reason to be strong from an actual pound side, not just from the US side, from a pound side. And it's gone from 141 down to 139, 138, and who knows, it could even go into 137, 136 in the next week. Then look at that Aussie. That one is the one that, as I said to you at the start of this video, that I'm watching quite closely. There is every reason now you could be chasing low 75s, even possibly top ends of 74-cent handles. Because despite all that data in the Aussie, it's all around risk and all around yields. And it's fairly easy to make an argument now that US yields are going to go higher, although they have been, in the main, trying to hold that off in the last sort of week. Rates are going higher, particularly the back end of the curve. And that is going to be quite a mover for the US dollar to the upside and quite basically a negative bearish signal for all pairs involved.